Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Phillips 66 is a downstream energy company headquartered in Houston, Texas. It was spun out of ConocoPhillips in 2012 and operates across refining, chemicals, midstream pipelines, and renewable fuels.
The company's origins trace back to 1917 when Frank Phillips founded Phillips Petroleum in Oklahoma. A century later, that heritage lives in a highly integrated system that converts crude oil into a broad range of energy products.
Refining is the largest revenue segment by far, roughly $35 billion. Phillips 66 operates a Gulf Coast refinery network designed for heavy crude feedstocks, providing cost advantages when light-heavy differentials are wide.
Marketing and specialties contribute about $15 billion in revenue, covering branded fuel distribution and lubricant products. Midstream adds around $3 billion from natural gas gathering, processing, and transportation assets.
The chemicals segment operates through CPC Chem, a 50-50 joint venture with Chevron. This JV converts petrochemical feedstocks into polyethylene and other materials, providing earnings that are structurally less cyclical than pure refining margins.
Refinery utilization typically runs above 90%. The key profitability driver is the crack spread, the margin between crude input costs and refined product prices. That metric fluctuates with supply, demand, and seasonal fuel patterns.
Mark Lashir became CEO in 2022. He previously led CP Chem as its president and CEO, so he brings deep chemicals and joint venture experience, a background that aligns with Phillips 66's push into higher-value downstream integration.
The Rodeo Renewable Energy Complex in California is a strategic bet on energy transition. By converting the existing Rodeo refinery to process fats, oils, and greases into renewable diesel and sustainable aviation fuel, Phillips 66 positions itself for regulatory tailwinds.
On the dividend side, Phillips 66 has increased its payout for 12 consecutive years and currently distributes approximately $4.60 annually. The yield reflects a commitment to returning cash even through commodity cycles.
Return on invested capital typically runs in the 12 to 15% range through the cycle. Not spectacular, but consistent for a capital-intensive industrial business. Free cash flow yield around 6% supports both the dividend and buybacks.
Valero and Marathon Petroleum are the closest pure-play refining peers. Both are strong operators, but Phillips 66's chemicals and renewables exposure differentiate it as a more diversified downstream platform over the long term.
The integrated model is the central thesis. When refining margins compress, chemicals or midstream can offset the impact. When crack spreads widen, refining amplifies total returns. Diversification smooths the cycle without eliminating upside.
Downstream energy is not a growth business in the traditional sense, but it generates substantial, recurring cash flows in a world that still depends on refined products at scale.
For income-oriented investors, a growing dividend, buybacks, and exposure to energy infrastructure makes Phillips 66 a distinctive way to participate in downstream energy.
That's the company chapter for Phillips 66. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Phillips 66 just delivered one of the loudest earnings surprises this energy season. Q1 2026, analysts expected a loss of 9 cents per share. The actual print was a 49-cent profit adjusted. That's a swing from red ink to clear black on a quarter. Wall Street had basically written off. Refining hit 95% utilization, dividend up 7%. This is charged alpha. Let's break it down.
Phillips 66 is not a pure refiner, and that distinction is the entire bull case. The company runs 4 reportable segments. Refining is the most visible, but midstream operates pipelines, terminals, and natural gas processing. Chemicals is the SPCM joint venture with Chevron, 50-50 owned, which produces ethylene, polyethylene, and specialty petrochemicals. Marketing and Specialties handles branded retail fuels, lubricants, and aviation.
Market cap sits around $71 billion. The diversified mix is the structural difference versus Valero or Marathon Petroleum. Midstream produces fee-based recurring cash flow. Chemicals captures global polymer demand. Refining provides cyclical upside when crack spreads expand. The trade-off: investors looking for pure refining torque get a more muted move because midstream and chemicals smooth the volatility. In Q1 2026, that diversification was both a shield and a partial break on the upside.
Let's walk the print. GAAP earnings were $207 million, or 51 cents per diluted share. Adjusted earnings were $200 million, or 49 cents. Revenue came in at $33 billion, up roughly 4% year over year. The adjusted EPS swing from the consensus estimate of negative 9 cents to a positive 49 cents is the headline most investors are reacting to.
Segment by segment, refining ran at 95% utilization with a realized refining margin of $10.11 per barrel. That margin reflects both indicator compression and improved capture impact, meaning operations executed better than the underlying spread environment would suggest. Crude inputs were down about 2% quarter over quarter due to maintenance and seasonal factors.
Midstream results declined sequentially due to lower volumes from Winter Storm Fern, lower margins from recontracting, and accelerated depreciation in the Permian Basin gas plant. But chemicals, CPChem, actually expanded adjusted pre-tax income on higher margins and stronger equity earnings of affiliates. That offset some of the midstream weakness and proved the diversification thesis.
Marketing and Specialties posted an adjusted pre-tax loss of $141 million. Renewable Fuels logged a pre-tax loss of $41 million. The headline number absorbed $839 million in mark-to-market losses across refining, marketing, and renewable fuels combined. Strip those out and the underlying operating performance is meaningfully stronger than the GAAP print suggests.
On the balance sheet, cash of $1.1 billion, total debt of $22.9 billion, equity of $30.2 billion. Net debt is $21.8 billion. That leverage looks heavy for a refiner, but a meaningful portion supports midstream pipeline assets that throw off contracted cash flow. Liquidity sits at approximately $6 billion. Trailing 12-month free cash flow is $2.7 billion.
Capital allocation tells you what management thinks about the cycle. They raised the dividend 7% in Q1. That's a signal of confidence in durable midstream and chemicals cash flow. Buyback activity continues alongside the dividend. The yield is now around 3.2%, which puts PSX in a different category than growth-only energy names.
Analyst consensus is the most interesting tension in this story. 5 buys, 12 holds, and 2 sells across 19 analysts. That's a hold-heavy book, despite a quarter that swung from expected loss to clear profit. The average price target is 163.62. With shares trading around 178, PSX is sitting roughly 9% above the consensus target.
There was a notable upgrade in the run-up. Morgan Stanley moved PSX to overweight from equal weight on April 24th and lifted its target to 174. UBS sits at the high end with a 212 target. The dispersion between bulls and bears here is unusually wide. That's typical of cyclical refiners, where macro views drive valuation more than fundamentals.
On valuation, forward PE is roughly 12.2 times. Forward EPS for 2026 is $14.63. Forward revenue is $142.7 billion. Price to sales is 0.49 times. Beta is 0.76, meaningfully less volatile than the broader market. That low beta is the signature of the diversified model versus pure refining peers.
The cautious analysts focus on refining cyclicality. Crack spreads can compress fast. Global capacity additions in Asia and the Middle East remain a structural overhang. The hold camp argues that even with this Q1 beat, you're buying a business whose largest segment is fundamentally tied to the spread between crude and refined products, and that spread has historically been volatile.
The bullish case from the buy-rated analysts emphasizes capital return durability. The 7% dividend raise plus active buyback signals management is comfortable with cash generation through cycle troughs. Combined with the midstream fee-based cash flow, the dividend looks well covered even in a softer refining environment. That's the bull pitch in one sentence.
The bull case rests on three pillars. First, structural diversification. Refining plus midstream plus chemicals plus marketing means no single segment dictates the earnings profile. When refining dips, chemicals or midstream often offsets, and that's exactly what happened in Q1.
Second, midstream recurring cash flow. Pipelines, terminals, and natural gas processing generate fee-based revenue that doesn't require crack spreads to cooperate. That base layer of cash flow funds the dividend even when refining margins compress. It's the closest thing PSX has to a software-style annuity stream.
Third, shareholder return commitment. The 7% dividend hike in Q1 plus continued buyback activity tells you management is prioritizing cash distribution over reinvestment in lower return projects. With 3.2% yield plus buybacks, the total shareholder return profile is durable even before any refining margin upside.
The bear case starts with crack spread compression risk. Refining margins are cyclical and globally exposed. Asia-Pacific refining capacity continues to expand, and any softening of U.S. gasoline demand could tighten margins quickly. The $10.11 per barrel realized margin in Q1 was solid, but it's not guaranteed to hold through the year.
Second, the debt load. $22.9 billion in total debt against only $1.1 billion in cash is a meaningful leverage profile. Yes, much of it supports midstream contracted assets, but rising rates and any earnings disappointment would compress interest coverage and pressure the dividend defense.
Third, global refining overcapacity. Saudi Arabia, China, and India have all added refining capacity in recent years. That structural supply growth is a long-duration headwind that no single quarter of strong margins can offset. PSX needs durably tight global product markets to justify a re-rating from current levels.
Fourth, consensus caution itself. 12 hold ratings versus 5 buys and 2 sells means the smart money on Wall Street is split. When the average target is below the current price, the path of least resistance is multiple compression, not expansion. You're buying into a street that doesn't want to chase the post-earnings move.
Versus Valero, the closest pure-play refining comparison, PSX trades at a discount on price to sales and a premium on dividend yield. Valero is more leveraged to crack spreads with less midstream exposure. If you want refining torque, VLO is the cleaner expression. If you want diversified cash flow with refining upside, PSX is the more balanced trade.
Marathon Petroleum is the closest structural peer, refining plus midstream via MPLX. MPC's midstream is partially separated as an MLP, which is a different corporate structure. PSX keeps midstream consolidated, which means cleaner reporting, but also more debt on the parent balance sheet. Both are viable models. Investors pick based on yield preference and tax treatment.
Hess is a fundamentally different business, upstream exploration and production with a major Guyana asset. Comparing PSX to HES is really comparing downstream versus upstream economics. Chevron, the CPC Chem joint venture partner, is the integrated supermajor, bigger, more diversified, lower beta, but lower torque on any single segment.
Among midstream MLP peers, PSX's pipeline assets compete with enterprise products and energy transfer. Those names trade as pure midstream and offer higher yields with simpler tax pass-through structures. PSX gives you a piece of midstream wrapped inside a refining and chemicals corporate. Different vehicle, different audience.
Options activity around the Q1 print was meaningful. Implied volatility had been pricing a roughly 4% earnings move, which was modest given the directional uncertainty heading in. The actual stock reaction was contained. The diversified model means the post-earnings reaction is rarely as sharp as a pure refiner with the same beat.
Open interest in the longer-dated calls clustered at the 180 and 190 strikes for the summer expiration cycle. That's institutional positioning for continued upside if refining margins hold through driving season. Put activity around 160 represented downside hedging by holders worried about a cyclical reversal.
On insider activity, the pattern is standard. Phillips 66 executives sell through pre-scheduled 10b5-1 plans. There's no unusual cluster of opportunistic selling that would signal management concern. Equity grants are the largest source of insider transactions, which is normal for a company of this scale.
Institutional ownership is over 70% of float, with Vanguard and BlackRock as the two largest holders. Activist exposure is something to monitor. Elliott Management has previously taken positions in PSX, advocating for portfolio simplification. Any renewed activist pressure could become a near-term catalyst around segment separation or capital return acceleration.
Bottom line on Phillips 66, a quarter that swung from expected loss to 49 cents adjusted, refining at 95% utilization, dividend raised 7%. The diversified model worked exactly as advertised.
The tension is consensus. 12 holds against 5 buys, with shares above the average target. Charged Alpha rates this a constructive hold. Strong execution, durable yield, but cyclical refining exposure means respect the street's caution on entry.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.